Hello. I'm happy to be joined today by Bob Hum from Blackrock. Foster Group began working with Blackrock, I think in 2018, 2019, when we began to take a harder look at things called factors, and Blackrock's research department was a big help to Foster Group in thinking about portfolio construction. Today, Bob Hum, our guest. Just a little bit about Bob. We had a chance to work with him over the years. He's a great communicator. I think you're going to enjoy hearing from him. Bob's the managing director at Blackrock and is the U.S. head of factor and co-head of outcome ETFs within Blackrock's Global Product Solutions Group. So in this capacity, Bob leads an overall product strategy for factor and outcome ETFs, which Foster Group uses some of those things through analytics, thought leadership, sales enablement, client engagement. Bob he's a frequent contributor to the news media as well, such as Bloomberg and Morningstar, and he's a regular MBA guest lecturer at Wharton and the Columbia Business School, so an academic side as well. Bob earned his BA in economics and business from Lafayette College and holds a chartered alternative investment analyst designation. So, Bob, thanks for being here today. We appreciate your time and looking forward to kind of having you share some things with our listeners, with our audience about factor investing. But I've got a couple general questions to get started with first.
Perfect.
All right. So, Bob, I just kind of read your bio, but, sometimes it's like, so what does this person actually do? What is it that you do on a daily basis in a company the size of Blackrock?
Yeah, sure. Well, Ken, I appreciate you having me on. And thank you all for the listeners. It's funny because I think my manager asked me a lot, what do I actually do as well? And so I think that the simple nuts and bolts of it, it is my job to represent our factors and our option-based ETF platform. And so that takes a lot of forms. One, it's talking to clients like yourselves and on podcasts like this to talk about general education around these topics. The second is thinking about, how do we build the right solutions for our clients? And then the third, it's really managing the day-to-day of these products, right? Making sure that the risk and the returns of these funds are what our clients would expect from these strategies. So every day looks really different for me, but it's something I've really enjoyed. And I've been at Blackrock now for almost 8 years.
Wow, that's fantastic. So in that role, you get to talk to a lot of people both inside of Blackrock and outside of. When you think about kind of investor concerns today broadly, what kinds of things are you hearing about?
Yeah, sure. So I would say there's two things that we're hearing the most. Number one, and it wouldn't be shocking given the reaction of markets recently, it's what do I do in these equity markets? I think, the markets have done really well the last 2 years. I think there's a lot of people that don't want to give up on those returns. And so people are gun shy of whether to get into the markets because we have record levels of cash, or should they be getting out of markets? For us, we try to take a long-term approach. It's not timing the market, it's about time in the market. I'm sure we'll get into that throughout the call, but that's been probably the number one thing that we've been hearing. And number two is really around rate expectations going forward, right? I think we came into the year with an expectation of 4 to 5 interest rate cuts. Then we went down to 0 cuts, and now we're back on to potentially 2 to 3, maybe even 4, depending on who you talk to. And so, how do you position portfolios given that uncertainty going forward is another thing that I think we've been hearing a lot of questions across individual investors all the way to institutions right now.
Yeah. Well, like you, we like to think long term, particularly about equity markets, because they can be so volatile in the short term, and a lot of things can move them around. Obviously, we just seen recently the spike in volatility and then kind of a recovery in just a few weeks. It seems like markets move very quickly. I was thinking about this morning. It's like economic numbers tend to move slowly, but the market just races in front and tries to interpret every economic number as quickly and as dramatically as they can. In terms of long-term development, though, for the way that BlackRock develops investment products, that people use, whether individuals or institutions like us, when you think about kind of innovations in the market or innovations in the marketplace, what are the things that stand out to you that have been really highly innovative in the last, let's say, 5 to 6 years, kind of the time you've been at BlackRock, maybe?
Yeah, sure. So I think there's been a clear, and this is a global trend, that ETFs is really a source. It's a a mechanism for innovation, right? And what we're seeing is investors across the globe gravitate to the benefits of an ETF, whether it's the transparency, the liquidity, and oftentimes the lower cost. And what I think is really unique over the last few years is the ability to take active strategies that have historically been in different wrappers, whether it's a mutual fund, a separate account, even sometimes a hedge fund, and bringing that to the masses through
Hmm.
the ETF vehicle. And so that's been probably the most exciting thing. I think you're going to see so many new launches of ETFs. I do think that also presents, so it's an opportunity for the ETF market, but it's also a challenge for folks like yourself, right? How do I, or for people on the line, how do I dig through the thousands of ETFs that are out there? How do I think about the due diligence process around those? And that's why I think folks like yourselves are so critical in this process, because although there's going to be an ample amount of choices oftentimes lead to really challenging situations. I'm thinking through these products. And so, we're seeing significant interest across like active ETFs, and so active portfolio managers running strategies in the ETF vehicle. I think you're going to see a significant growth there. And the other is more complex solutions, things like options-based strategies in the ETF wrapper that have historically been in structured notes or annuities. I think that's probably the next wave of innovation that we're going to see.
So, what is it about the ETF structure you think that has kind of led or created some of this burst of innovation, or kind of the variety of things that we're seeing? There seems like there's something unique about that structure that has just generated this kind of invention or innovation.
Yeah, I would say it's probably twofold. Number one, it's the ability to tax manage in a portfolio.
Mm.
And I think taxes have become more and more higher priority for especially our high net worth individuals. And some of the techniques you're able to utilize in an ETF structure are advantageous from a tax perspective, right? And so if you think about mutual funds, you oftentimes see some capital gains, even if you didn't sell the fund. Oftentimes that is alleviated in the ETF wrapper. Doesn't mean you can't get a capital gain in an ETF, but you'll see ETFs historically have been much more tax efficient than a mutual fund. The second thing I think is liquidity, right? I think more and more folks want that daily intraday liquidity that some other structures don't provide. And I'm thinking even more so in the newer products that we're seeing on the options side. If
Mm.
you look at historical structured notes or annuities, those oftentimes have a penalty when we're redeeming early, things of that nature. The ETF alleviates a lot of those pain points for investors.
Yeah, we've certainly seen both of those things as favorables here. And, just the cost of transaction, due to the fact that so many custodians are allowing transactions with an ETF without a transaction fee, that allows, just a little more regular rebalancing. Maybe smaller trades can be made to fine tune a portfolio without the worry about the cost of the trade. So
Yep.
it's been a good innovation in our view as well. Let's talk a little bit about factors, since I've got you here and you're the factor guy as I think about you over there at Blackrock. Foster Group for a long time has really constructed portfolios with the idea of using factors. Sometimes in the past they've been called premiums, but that just means we tend to emphasize in the portfolio stocks. We'll talk about stocks here specifically, that tend to have maybe a lower price or a value bias. We talk about smaller companies versus larger. We talk about companies maybe have a quality earnings or a profitability metric that seems to be favored. And then more recently, we began to talk about momentum and minimum volatility as factors as well. When I think about that, the idea behind factors is that, hey, there's something about these stocks that exhibit these factors that say that their expected return over longer periods of time may be a little bit better than the market neutral portfolio. So the $1 million question is, why are factors or stocks that exhibit these factors, why do you think they're rewarded favorably, or at least expected to be rewarded favorably, above a general market return?
Yeah, absolutely. So, oftentimes it really comes down to two things, and you could say that there's a third, and I could get into that. But usually there's two reasons why certain securities are favored over others over the long term. And I want to emphasize over the long term,
Yeah.
because at any given point you can see a factor underperform or outperform, and we've felt that. We've all collectively felt that in different periods of our careers. I think the first, and you hit on it, is you're rewarded for taking some risk. right? Whether that's value is a good example. You're oftentimes rewarded for the uncertainty of owning a company, whether that's maybe those companies, the industry is in a decline or there's something challenging in industry, and you're rewarded for taking the risk of owning that security through those painful times through and seeing it through. The other could be behavioral biases, right? So a good
Mm.
example is momentum, right? Momentum is the idea that stocks that are trending well tend to continue to trend well before reverting back. And so momentum is playing off of the idea, and I call it almost like the FOMO effect, right? People start to see a name come up on the screen, they see it doing really well, they want to pile into that trade. So a momentum strategy tries to own those securities through the upswing and then systematically sell them earlier than when they tend to revert back. And so I think when thinking about factors, it's important to note that there's not hundreds or thousands of factors that we believe are rewarded. I think the 5 that you've just mentioned are the ones that we align with as well. And so I would say a couple things along that lines of why are those the 5 that we've chosen. I think number one, we've seen them historically work, right? Not only work in the U.S. market, but we've seen them work international markets. You've even seen them work in different asset classes. A good
Mm.
example, if you're looking to buy a home right now in a neighborhood, you want to buy if two houses are the same, you want to buy the one that with the lower price, right? That's the better value
Mm.
of purchasing. The second they add diversification to each other, right? So certain factors will perform differently. So today's environment might be quality and profitability that you mentioned, but tomorrow's
Mhm.
environment might be value. So there's benefit to owning both. The third, they need to be scalable, right? So we want something
Mhm.
that you can actually own and actually harvest that premium or that return. And then the fourth, for us, and this is something that's really it's tangible across different regions. And I mentioned asset classes
Mm.
first.
Mm.
Regions is
Mhm.
really important, right? So we want to make sure that this isn't an anomaly that we see in a very small niche part of the market. We want to make sure that that is broad, so that we understand that we think that can persist over the long term.
Yeah. The risk-based story, I think, is an interesting one. I mean, one of your colleagues, Andrew Ang, he talks about the reward for holding a factor. You get rewarded for kind of enduring the bad times, if you will. And, so that kind of implies like, well, I guess you're telling me there's going to be bad times because maybe there's just what you've described. There's a little bit more risk associated with owning the factor versus just owning the entire market at one time. Describe, if you would, Bob, just what are the risks, associated? I know sometimes we talk about things like tracking error or underperformance, but when you think about risk, how the investor experiences risk if they own a factor, let's say like if they choose to own small companies versus large companies, how are they going to experience risk and why might that be rewarded?
Yeah, sure. So, um, if you think about factors, it's important to note that they are cyclical. So, depending on where we are in the economic cycle, certain factors should perform better than others. And so, if you think about those 5 factors that you mentioned, coming out of a recession, you want those higher risk factors like value or small caps.
Hmm.
During an expansionary phase, that's when trends are starting to form. That's what you'd want momentum. And during a slowdown and a contraction, you want some ballast in the portfolio, quality, minimum volatility. So the risks are, depending on where we are in the cycle, if you own one of those factors, it might be out of favor. Now, these are long only stock portfolios. So I think of it as a relative performance, right? The risk is a relative underperformance versus if you owned the broad market like an S&P 500, like an IVV or something along those lines. And so I think one, there's timing risk to these. And that's
Hmm.
why, and I'm sure we'll talk about
Hmm.
this, we think about
Hmm.
diversifying across the different factors, similar to what you all do at Foster
Yeah.
Group. And then the second is, thinking about the relative risk of what you could be owning, right? You could be owning just the broad market. You were making an active decision to own a more cut down version based on the historical empirical evidence that we've seen in factors.
Right. Yeah, I think that idea of comparing to the market is the important one when we think about risk, particularly with factors, because it is, as you described and we talk about too, a relative risk, meaning if I'm comparing to something, let's just say the broad market at this point, and value happens to be out of favor and growth is in favor, well, if I have more value in my portfolio stocks than the market does, I'm going to likely underperform the market for a time. So the risk there is, hey, you've got a tracking error, something that looks different from the market, and it's a negative tracking error. You look under the market for this time. But as you're describing it, there's a cyclicality to that, and the expectation is that over time, value stocks come back into favor, and over long periods of time, at least in the academic literature, it seems to indicate that these 5 factors we've been describing, that they've been positively rewarded, and there's kind of an economic intuition as to why that taking that kind of a risk is rewarded. I read a book a number of years ago called Adaptive Markets by Andrew Lowe from MIT. And his thesis there is that, like a lot of things over time, there's just change or evolutions or adaptations as markets go along. So new things emerge. Do you think that factors have some kind of have they evolved? When you look at kind of the history of factor investing, has there been changes or evolutions, the things that you think, this was the case, maybe this isn't the case going forward, either in the factor itself or maybe just the degree to which it's rewarded?
Yeah, sure. So the way that we think about it at BlackRock is, we don't think it's a revolution, but there is an evolution, right? So we don't think the factors change. We don't want to look at value. We don't want to look at quality. But the way that we actually analyze those companies for those factors could change, right? Because business models change, the markets change. And I'll just give you an example. Within value, so value, you're just trying to buy companies that are cheap relative to their fundamentals. And historically, one of the best ways to do that is looking at the book value of a company relative to its price, right? That is where the academic literature started from. Now, our view is that company business models change over time, and maybe we want to start to look at things like earnings over price instead of just book to price. It doesn't mean we don't believe in value, but we think we can evolve the way that we describe those characteristics. And if you look, and I actually pulled this up recently, if you look over the last 3 years, and just because they're both value signals, there's been a 19% performance difference between just the standard, things like forward earnings to price versus book value to price. And so it doesn't mean we're going to change what we look for, but the way that we analyze those types of companies may evolve over time.
That's super interesting. Yeah, we were having this conversation amongst our advisors here at Foster Group just the other day, and I think one of the questions I have is the kind of as the market evolves, as things change, certainly the kinds of companies that we see in business today versus the kinds of companies we saw in business 50, 60 years ago. I mean, we had railroads and oil companies, and telecommunications was just getting started 50 years ago or longer. Now we have, artificial intelligence, digital technology tends to kind of run the market, at least right now. And one of the questions is, hey, should we weight the data or the evidence from, let's say, the 1920s to the 1950s? Should we give it the same weight in our evaluation as data maybe from the 1990s or even 2000 to 2024? Do you guys think about, hey, where is the most relevant data and how would we parse out or recognize something that's changing in the market?
Yeah, sure. So, look, I don't think you can throw away the past, right? I think it's helpful information and pointing us in the direction that we want to move to. But I do think markets evolve. And so when we think about some of the signals that we're putting together, we weight those signals, we absolutely will give more credence to more recent information than from the longer term information. Doesn't mean we don't use that longer term information to make decisions or enhance our ability to make decisions, but we definitely will overweight the more recent information than we'll the longer term. And I think that hopefully reflects both the long-term nature of these factors and understanding why they drive returns, but also taking into account that markets do evolve, and we want to be not overreacting to short-term trends, but at least taking them into account of what's going on in the markets today.
Yeah, I think that's a challenge for individual investors or institutions as well. This idea of you want to be open to the idea that things probably do change over time. At the same time, just what you mentioned about cyclicality, some things like, well, it appears like it's different or that something has changed fundamentally when really you're just going through that cycle. And as things have been in the past, they tend to repeat or seem similar in the future. There's no, guarantee that that's going to be the case, but I think that is the tension for investors is like, okay, what fundamental ideas am I going to hold on to and not really let go because this is a principle? And then how do I apply those principles in a world that really does, there is some things do change. Certainly large language models and AI would say, yeah, that's something new that we didn't have 30 years ago. And it's driving a part of the market that, we just haven't seen before.
Yeah, and one thing that I realized I missed when thinking about those four principles, the most important is economic rationale, right? Is there actually a rationale of why that factor should persist going forward? And you can apply that really to anything, right? Is there an economic rationale of why something's underperforming, right? So, for example, today small caps are underperforming the market, and we've seen that over the last few years. Well, there is some rationale behind it, right? So if you think about smaller cap companies, they tend to have higher floating rate debt, right? So if you think, and they tend to be higher indebted companies in general. And so in a high interest rate environment like we've seen over the last 2 years, you would expect those companies to be more punished than higher quality companies that have either lower debt or they have really long-term debt that is not as impacted by short-term rates. And so those are just some of the things that we're trying to think through so that you don't overreact to changes in the market, but you are also, to your point, open to changes if there are structural changes that we see.
Yeah, that's good. Really good. So when you think about investors who are trying to make a portfolio decisions for themselves personally, do you have a view? Should every person hold kind of a multi-factor portfolio? Are there particular factors that you think maybe should be or should not be held based on an investor's circumstances?
Yeah, sure. So our first tenet is that you should be diversified across factors, right? The easiest way to alleviate the pains of the cyclicality that we talked about is diversifying across, right? So if we think about factors, if historically they've all been rewarded over time and they're diversifying amongst each other, that's the free lunch of investing, right? Diversify across a lot of assets. That's going to reduce some of the drawdowns that you see out of any individual factors. So that would be our first tenet. The second, and this is really going to come up to individual circumstances, right? We know certain factors have different characteristics or risk return profiles than others. So what I mean by that, things like value and small caps tend to be more volatile than minimum volatility and quality. And if we think about that economic cycle, you understand where they sit. Maybe investors that are closer to retirement have higher weights to those more defensive factors. Quality, minimum volatility, because they can't withstand some of the drawdowns that you see. And of course, it's the same reason why someone that's closer to retirement might own a 20% equity portfolio, 80% fixed income versus someone that's 30 years younger that owns 80% equities, 20% fixed income. You can kind of shift which factors to own as well. And so, that's definitely going to be individual dependent, but I think those are some of the things that we like to think about depending on risk tolerance of the clients.
Yeah, I think that's a good one. We often think of risk management as kind of the mix between stocks, bonds, and cash. But within each one of those, particularly maybe not cash, but at least within fixed income or bonds and stocks, there's different kinds of risk factors in both of those asset classes. And depending on kind of the investor's time horizon, what their financial goals are, how much time they have in the market, even their just personal individual preferences for volatility or about not wanting to experience as little volatility as possible. There's ways to adjust both the equity side of the portfolio as well as the fixed income side to maybe accomplish some of those goals. We can't eliminate volatility, but there's ways to manage that down. Yeah, of course, that brings up the question, when you think about returns associated with managing risks down, we tend to think there's a risk and return story, that those two things are still related, and that in order to enhance risk or to increase expected return, investors may need to be comfortable or take a little bit more risk. When you think about kind of the future of markets right now, I'm going to ask you a question, one tongue-in-cheek and one real. The tongue-in-cheek question is the one that we get often asked, is like, what do you think markets will look like in the next 12 months? And then, but the real question is in terms of kind of that risk return, where you think markets are going, or more likely to reward investors over 5 and 10 year periods. What do you think about the health of the market generally going forward? If you have any thoughts short term, that's fantastic. I'd love to hear them. But I'm also really interested in what your thoughts are about kind of the long-term shape of markets.
Yeah, sure. So I'll answer both. The first one, I don't know. I don't know where markets are going to be in the next 12 months. I think most people don't know where they're going to be in the next 12 months. I do know that there's some principles that we should all take with us. And I mentioned at the top of the call is, it's about time in the market and not timing the market. And I think coming up to an election, this is really important. And someone said it well: don't let politics get into the portfolio. And one research or some analysis that we did that I think was really helpful for people thinking about, either one getting out of the market or one getting into the market. So we looked at over the last 20 years, if you were invested $100,000 into the S&P 500, you'd be at about $635,000 today. If you removed the 5 best trading days of that 20-year time horizon, that $635,000 goes down to $400,000. If you missed the 10 best trading days, $291,000. And now people on the line are going to say, well, what if I remove some of the worst days? Well, oftentimes worst days are clustered with the best days. So it's really hard. And I think the most recent market environment is the perfect example of that. We saw this huge spike in the VIX, and what's happened, the market's recovered. And if you were actually, asleep for the last couple of weeks, you probably wouldn't even notice the returns of the S&P, right? Maybe it's down a couple percent. Right. And so I think that would be my first answer, somewhat tongue in cheek, but also I think some principles that we should all abide by. In regards to the expected return of factors and just the general health of markets, look, I think it's important to note that when we say markets and the health of them, it's dependent on which regions that you're looking at. So a great example, everyone has talked about the underperformance of value over the last few years. That's a U.S. phenomena. If you look in international and emerging markets over the last 3 years, value's actually outperformed the market. And that's actually one of the reasons why we have credence in believing in value. We have seen it work in other regions, but the U.S. market's been a little different. And so the biggest difference is the concentration that we've seen in markets over the last 2+ years, maybe 10 years, actually. Last year, 65% of the market S&P 500 returns were driven by the Magnificent Seven. This year, up until recently, it was closer to 50%. And so that's not the healthiest of markets, right? When a few names are driving the returns. So one thing that we're hoping for and think that will probably play out over the next few years is a broadening out of equity markets. And we would call that breadth. Breadth is good for factors. Breadth is really strong for factors because we're not trying to make individual bets on individual stocks. We're trying to buy cohorts of securities that have certain characteristics. And so to me, that's the benefit, or one of the positive things going forward for factors is a broadening out. We saw it a little bit in July. We'll see if that persists, but over the long term, we would expect there to be more market breadth, which should be a positive for factors going forward.
Yeah, it's a good word. I think that long-term health of markets, people worry that markets are not resilient or somehow less so. And history has kind of shown over and over again that markets tend to be resilient. They can suffer from time to time, but companies and the people who lead them, their job is to be profitable. And so once they know what the rules are, as long as the economy the rules allow for private ownership and investment in private companies, and those companies still have that profit motive, the likelihood of companies figuring it out and staying or becoming profitable just goes up, which means investors get to benefit from their participation in the market. It may not be immediate, but over long periods of time, that tends to work out.
And I would say interest rates coming down it's a huge factor for those things, right? So that is going to be it's been a tax on companies. It's been a tax oftentimes on the economy. Depending on where you are in that in from a wealth situation.
Yeah.
That's going to be a tailwind, I think, for markets. And so there's definitely a lot of things that are on the positive side. You always have
Hmm.
to be mindful of risk. I think what last couple of weeks have shown is that risk comes at the most inopportune times and when people least expect them. And
Mhm.
so and for the least expected reasons. And so having a well diversified portfolio, having some of those key tenants in place is really critical so that you can withstand some of these pullbacks that we always expect, right? I think something I saw recently, if you look over the last 20 years, the average intra-year decline, even though the markets have done double-digit returns, is close to 14 or 15%. These things
Yeah.
happen. I think people forget that they happen, but they happen actually quite often. And
Yeah.
markets still are pretty resilient through those periods.
Yeah. We try to bring that up periodically with investors as well. The declines are normal. They're in a way they're to be expected. What happens is what causes them or when exactly they occur. Very hard to predict. Really almost impossible to predict. But the fact is we should be expecting them to occur sometime. It's kind of like a recession. Really within a recession, you're like, well, you're you're either just coming out of one, you're in between, or you're just going into one. There will be another recession. We don't know exactly when it will be. It could be far away. It could be relatively close. But it's the same thing with drawdowns in the market. They do occur pretty much annually. We just don't know which month or what the trigger might be to cause that.
Yeah, I mean the one that I always forget this, but I mean 2020 is the perfect example. We were
Yeah.
down 30% at one point for the S&P, and then we finished up close to 20%, up 20%. And so those swings happen. Hopefully not those extremes,
Yeah.
but they happen, and I think markets can recover pretty quickly.
Yeah, that's great. Well, Bob, hey, thanks for being our guest today. I really appreciate your time, your insights. We appreciate our partnership with Blackrock. You guys have been really helpful for us as we think about portfolio construction and just market research in general. Our goal for these podcasts that we put out is to contribute to our listeners becoming educated and prepared optimists. We think there's reason for that. If there's topics or questions that you'd like as a listener for us to address, please let us know at our website, which is www.fostergrp.com, and click on the words Financial Perspectives. And if you're listening to this as a podcast, you can help us spread the message of educated optimism by liking us on your podcast app. As always, thanks for investing some of your time and attention with us. And Bob, thanks again. We appreciate your time today. Been great.
Thanks for having me.